Hey, crypto enthusiasts, ever wondered how your crypto gains are taxed in Japan? It's a bit different than other countries, and honestly, it can be pretty complex. Japan has some unique rules, especially when it comes to how your crypto profits are classified and taxed. In this video, we're diving deep into Japan's crypto tax landscape for the 2026 tax year. We'll break down the current system, the progressive tax rates, the specific cost basis methods you can use, and even touch on the proposed reforms that could change everything. By the end, you'll have a much clearer picture of your crypto tax obligations in Japan. Let's get into it. So here's the deal right now. Japan taxes cryptocurrency gains as what they call miscellaneous income. That's zashotoku in Japanese. What does this mean for you? Well, your crypto profits get lumped together with your total income, and then they're hit with progressive tax rates. These rates can go all the way up to a whopping 55%. That's a combination of 45% national income tax, plus an additional 10% resident tax. Unlike a lot of other places, Japan doesn't currently treat crypto as capital gains, which usually means lower, flatter rates. The tax year in Japan runs from January 1st to December 31st, and you've got to file your annual tax returns, or kakutei shinkoku, between February 16th and March 15th of the following year. So if you made crypto gains in 2025, you'll be filing in early 2026. Now, let's talk about those progressive tax rates because they're a big deal. Since crypto gains fall under miscellaneous income, they're subject to Japan's income tax brackets. When you factor in that flat 10% resident tax or juminzi, the effective rates can climb pretty fast. For example, if your taxable income is over 40 million yen, you're looking at that maximum 55% rate. To put that in perspective, traditional stock and securities gains in Japan are taxed at a flat 20.315%. See the huge difference? This disparity is why the Japanese crypto community has been pushing for separate taxation reform for years. They want crypto to be taxed more like stocks with a lower fixed rate. When it comes to calculating your crypto cost basis in Japan, you've only got two options, both set by the National Tax Agency or NTA methods like FIFO, LIFO, or specific identification, common in places like the US, aren't allowed here. Your first option is the total average method or Sohei Kinho. This is the default. With this, you figure out your unit cost by dividing the total cost of all crypto you bought during the year by the total units. The catch, you can't know your final cost basis until December 31st because every single purchase you make throughout the year impacts it. Your second option is the moving average method or Aidohei Kinho. This one's a bit more dynamic. It recalculates your average cost basis after every single purchase. Active traders often prefer this because it gives them a real-time cost basis. But if you choose this, you have to file a notification with your tax office, and you're logged into it for at least 3 years. Choose wisely. Here's a little silver lining for some, the 200,000 yen exemption rule. If you're a salaried employee and your total miscellaneous income is 200,000 yen or less per year, you might be exempt from filing a national income tax return. This is pretty sweet for casual investors with small gains. But, and this is a big but, there are two crucial things to remember. First, this exemption only applies to national income tax. You still have to file a resident tax return with your municipal office no matter how small your gains are. And second, this exemption applies to your total miscellaneous income. So if you've got other income sources like freelance work or foreign currency gains, they all get added together with your crypto gains to hit that 200,000 yen threshold. What's on the horizon for Japan's crypto tax? There's a strong push for what's called separate taxation reform. This movement aims to change how crypto is taxed, moving it away from miscellaneous income and towards a separate flat tax rate, similar to how stocks and other financial assets are treated. The goal is to make crypto taxation more fair and encourage innovation within the digital asset space. If this reform passes, it could dramatically reduce the tax burden for many crypto investors, especially those with higher earnings. Imagine moving from a potential 55% rate down to something closer to 20%. This is a big deal for the Japanese crypto community, and many are hopeful it will be implemented soon, possibly impacting the 2026 tax year or beyond. We'll be keeping a close eye on developments here. Navigating these unique Japanese crypto tax rules, especially with those specific cost basis methods, can be a real headache. That's where tools like dTax come in. We support 18 different blockchains, including Ethereum and Solana, and even tackle complex DeFi transactions like LP tokens and airdrops. With dTax, you can easily import transactions from 26 plus exchanges using CSVs or sync directly with major platforms like Binance and Kraken. Our system is designed to handle both the total average and moving average cost basis methods required by the NTA, helping you stay compliant. Plus, our free tier lets you handle up to 50 transactions and 5 AI chat queries a day. Check out getdtax.com. It's open source and free to start. The key takeaway for Japan crypto taxes is this. It's complicated, and those 55% rates are no joke if you're not careful. Understanding the miscellaneous income classification and the specific cost basis methods is crucial for staying compliant. Keep an eye on that separate taxation reform. It could be a game changer. If you found this video helpful, please give it a thumbs up, subscribe for more crypto tax insights, and hit that notification bell so you don't miss our next video. Thanks for watching, and we'll see you in the next one.